BNN Bloomberg.
From home growing to big business, BNN Bloomberg goes in-depth on Canada's booming marijuana industry with Cannabis Canada. Continuing coverage on BNN Bloomberg and bnnbloomberg.ca.
Next time on BTV, we go in-depth with this exciting small-cap company.
InMed Pharmaceuticals is a pharmaceutical company who's working with a specific class of compounds called cannabinoids. There's a whole host of relatively rare skin disorders that we think cannabinoids would be well suited for in terms of treatment. It's rare to find a company that is at this early stage that's going to make a real difference in the pharmaceutical world.
Watch us online, on Air Canada, or here on BNN.
What separates RBC ETFs from the others? Thoughtful design, sophisticated risk management tools, global expertise, all backed by Canada's largest asset manager. RBC ETFs, from a provider you can count on.
A global wireless technology leader, Baylin is one of the only Canadian mid-cap companies developing 5G applications. With 4 major businesses in the wireless space, Baylin is rapidly advancing its reach. Baylin Technologies.
As our world becomes increasingly digital, Internet of Things Inc. is turning big data into actionable intelligence by investing in companies like Weather Telematics, the newest addition to their portfolio. Internet of Things Inc.
Horizons ETFs, bringing many firsts to Canadian investors. HMMJ, the world's first marijuana ETF. Mind, the world's first global equity ETF driven by AI. Arbot, Canada's first ETF focused on robotics, automation, and AI. Put your portfolio first. Active, indexing, tactical. Horizons ETFs. Innovation is our capital. Make it yours.
From one of the founders of Pay by Phone, Glance Technologies is powering merchants and users with an award-winning mobile payment and rewards platform, leading the mobile and blockchain revolution. Glance Technologies.
This BNN Bloomberg program is brought to you in part by Biome Grow. Biome Grow is Canada's next cannabis conglomerate.
Time for the morning call on this Monday morning. Andrew McCreath here to help get you set up for the trading day ahead. Hello.
Good morning, John.
How are you, sir?
I'm fine, thank you. And there's little question that things are not all fine in China as the government continues to take actions to manage the slowdown. Regulators have suggested that banks should take it easy on companies that are struggling with debt issues at this point in time. And meanwhile, regulators are looking to decrease the sales tax that consumers pay to buy a new car from 10% to 5%. The Chinese auto market, which of course is about 50% larger than the U.S. auto market now from the perspective of sales per year, has fallen for the first time in more than 10 years over the last 12 months. So the regulators are looking to cut taxes to try and boost demand.
Yeah, but you're on the fence as to whether or not that's something that helps out the economy in a big way?
In a grand scheme of things, it helps, but doesn't offset the bigger headwinds that the Chinese economy is facing. So I think there's little question that it's going to continue to slow down. And how Premier Xi just chooses to respond to Mr. Trump is still an open question. I still think the Chinese are waiting until after the midterms, which, you know, it's next Tuesday. A week tomorrow is the midterms in the States. And clearly, perhaps their actions or lack of actions lately with respect to trade initiatives and the Americans imply that they're thinking that it's going to go one way or not the other. In other words, they may be thinking that the Democrats are going to sweep, and consequently they'd rather wait until after the midterms because they think they may get a little better traction on some of their ideas.
I mean, I got this. We talked to Art Hogan, a strategist, earlier. I got the sense that he thinks the China-U.S. trade story is the one that maybe changes changes the market dynamics if the U.S. hypothetically, you sort of explained the math there, but if there's a decision to allow cooler heads to prevail in that matter on the U.S. side, that maybe would change the story of the stock market weakness that we've seen.
100%. I mean, that's like saying whether or not you're happier on a day when it's sunshine and 75 degrees Fahrenheit outside. Of course you are, versus a cold, rainy day like we experienced most of the weekend here in Southern Ontario and are going to experience most of this week again. But when you look at what's going on in the auto market, we talked about China. Well, in the United States, it's auto sales that cause real spending in the month of September to be up 1.8% month over month, or I should say year over year. And that was largely driven by Hurricane Florence and folks having to replace their cars. But when you look at spending on services, it started to slow down. When you looked at income for the month year over year relative to spending month over month, year over year, it was not favorable. In other words, spending was greater than income growth. So a lot of pundits are suggesting we're seeing a bit of a slowdown, or going to see a little bit of a slowdown in U.S. consumer spending here. And I think that there's little question of that. But it's not just because consumers maybe aren't making as much money, or at least the bottom 80% of consumers aren't making as much money as Trump would like to make you think that they are, but also input costs are really hampering companies' ability to maintain margins and push the same amount of volume they did before. You look at a company like Colgate-Palmolive, toothpaste, toothbrushes, mouthwash, all that kind of stuff. They had their third straight horrible quarter late last week. They missed margins, they missed market share, they missed volume growth, they missed revenue growth, they cut their outlook. If you look at a 5-year chart of this stock, it's gone absolutely nowhere. This is a company that speaks to mature, large cap, North American consumer staples, and that's a 1-year chart, but when you look at a 5-year, it's literally gone nowhere in 5 years. Lots up and downs, but point to point, nowhere.
So, I mean, the thing, like earlier in the show, we heard people saying that some of the staples have richer valuations, and maybe in this time where there's selling in other areas, these companies look a little pricey perhaps, even in the face of what you're saying are some disappointing earnings.
Absolutely. I mean, I suggested to you last week, John, that I believe the markets will rally after the election. Okay. It's a bit of a safer bet to say that, given what's happened during the month of October, but there are folks that are getting increasingly bearish all of a sudden. Isn't it interesting what a few percentage down does to people's psychology with respect to stocks? But I think stocks rally after the election. But when you go out to, say, March 19 versus August of 18, point to point, I think they're generally flattish, but you're going to see lots of flip-flopping, defense, offense, growth, value, domestic, international in between. And when you look at what's gone on in financial markets over the last few weeks, the Canadian REITs are up. They're actually having a pretty good year. REITs are up 8%, which of course defies logic if you believe that REIT stocks only benefit from falling interest rates, because of course interest rates are up year to date in Canada. But that speaks a little bit to your comment about defense, offense. Yeah. The U.S. staples, the REIT stocks are places where people go when they get nervous about the more cyclical, the more growth, the more